What is a PE ratio? This is Prof. Yes, Profit, your professor of profit, and I'm going to be talking to you today about PE ratios, something that is used a lot within finance. People talk about it the whole time. What is a PE ratio? Well, really, PE stands for price to earnings ratio. What is your price per share to the earnings per share that the company is making? So if we look at that formula, and it's used a lot within the stock exchange when people are looking to buy shares, that PE ratio is price per share divided by earnings per share. Your price is the price you pay today. The earnings is the earnings that the company has made in the last year or the last time it reported those earnings, divided by the number of shares. So you get the earnings per share. If the price, for instance, is $5 and the earnings is $1, your PE ratio will be 5. That's 5 to 1. You're paying 5 times the earnings to buy the share. And one would normally buy a multiple of the earnings. Now, if we take the same ratio and we turn it on its head, you get something very similar, but it's got a different name. It's called an earnings yield, and the earnings yield, as you can see, is the exact reciprocal of that. Earnings per share divided by price per share. If the top one gave you 5 to 1, the bottom one will give you 20%. How do I get 20%? It's 1 divided by 5 is 20%. The top one tells you you are paying 5 times the earnings to buy the share. The bottom one is telling you that every year you earn 20% of the share price. So as you can see, it's giving you the same information, because if I earn 20% every year, it'll take me 5 years to get there. And that's the PE ratio and the earnings yield. The PE ratio, by the way, is the number of times annual earnings as they are at the moment. So if it's 5, it's 5 years worth of earnings. Just a quick note, a PE ratio of less than 10, the company is seen as what we call a value share. A PE ratio of greater than 20 is seen a growth share, meaning you will only pay, or you should only buy a share that has a PE ratio of greater than 20 if you expect massive growth. Let's look at Apple, for instance. The PE ratio for Apple is 11.64. The forward PE is a little bit less than that. So here you've got a PE ratio and a forward PE ratio. Your PE ratio is the price as it is today based on the earnings the last time it was reported. The forward PE is used normally when we're getting closer and closer to the new reporting of earnings, and it's based on what we expect the future earnings to be. Now, if you like these videos, if you want to watch more of these, subscribe to my channel. Press the subscription button for the channel below. It's for free. This is Prof. your professor of profit. Hope you have a profitable day.